Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our lessons on investment appraisal, and we are going to solve a complex question for the accounting rate of return, as well as solve one for the payback period. And then we can zoom into the discounted cash flow methods. So the first question we are going to solve is on accounting rate of return. And so without wasting much time, let us look at the question and then solve it together. A capital project would involve the purchase of an item of equipment costing 240,000 Ghana cedis. The equipment will have a useful life of 6 years and would generate cash flows of 66,000 Ghana cedis each year for the first 3 years and 42,000 Ghana cedis each year for the final 3 years. The scrap value of the equipment is expected to be 24,000 Ghana cedis after 6 years. An additional investment of 40,000 Ghana cedis in working capital would be required. The business currently achieves a return on capital employed as measured from the data in this financial statement of 10%. So that is the return on capital employed that they have from the financial statement, 10%. Required. A. Calculate the ARR of the project using the initial cost of equipment to calculate the capital employed. B. Calculate the ARR of the project using the average cost of the equipment to calculate the capital employed. And then C. Suggest whether or not the project should be undertaken on the basis of its expected ARR. All right, so this is the question. You know, I have already taught you the two different approaches to calculating the accounting rate of return, or the ARR. The first one is the initial cost approach, and the other one is the average investment approach. Now, this question expects us to use both approaches. We are first going to use the initial cost approach to calculate the accounting rate of return, and then we are also going to look at the average investment approach, where we have already solved the question previously on that. And so let us not waste much time. Let us go on. Now, in analyzing this question, you realize that the cost, just as I have been telling you, you always have to list some of the key things down. So the cost of the equipment is 240,000. That is the initial cash outflow. And then we are also told that there will be an additional working capital investment. And the working capital investment is also going to be 40,000. The estimated useful life of the project is 6 years. And there is an estimated scrap value at the end of 24,000 Ghana cedis. So these are the key things that we have listed down from the question. Now, what we need to do is that we all know that we have to get the average profit, the formula for accounting rate of return, ARR. We are using two approaches. We are using the initial cost approach and the average investment approach. But whichever it is your average profit over the initial investment. That is if you are going by the initial investment approach, times 100. If you are going by the average investment approach, your accounting rate of return is your average profits over the average investment. And I have already taught you the formula for finding the average investment. And I'm going to do that again, times 100. So the requirement A says we should use the initial investment approach. Requirement B says we should use the average investment approach. Whichever approach we are using, the average profit must be calculated. So I therefore wish that we should first find our average profit. We have been giving cash flows for 6 years, okay? And then there is depreciation that we must calculate. Remember that I have explained that to get your profit in accounting rate of return, it is your cash flows minus the depreciation charge. That is going to give you the profit. And when you get the profit for each of the years combined, for the total lifetime of the project, you divide by the number of years, which is 6 years, to get your average profit. So if you have a profit for the total number of years, we are going to add up all the cash flows, and then we are going to subtract the total depreciation. When we do that, we are going to get the total profit for the 6 years. And then we divide by 6 to get the average annual profit. And that is what we will use on the formula. And then we divide by the initial investment or the average investment, depending on the approach we are using. And so let us first find the average profit. Now, to find your average profit, you need to consider the cash flows. We are told that for the first 3 years, the project will generate cash flows of 66,000 each from the question. 66,000 each. And then 42,000 Ghana cedis from the 4th year to the 6th year. And therefore, from year 1 to 3, we have 66,000 as the cash flows. And it's multiplied by 3. The reason why I'm multiplying this by 3 is because 66,000 will be achieved for 3 years. And then for year 4 to 6, it's going to be 42,000 times 3. Okay, so we want to look at the total cash flows for the period, and then we subtract the total depreciation so that we can find our average profit. Now, 66,000 for year 1, year 2, year 3 is going to give us some amount of cash flows for the 3 years, which is 198,000. And then 42,000 times 3 is going to give us 126,000. Okay, so what we are trying to say is that from year 1 to year 3, we are getting a total cash flows of 198,000. That is 66,000 for each year. From year 4 to 6, we are getting 126,000. So when we add them up, we are getting a total of 324,000. So ladies and gentlemen, this is the total cash flows that is coming from the project for the 6 years. But remember that we are dealing with profits, not the cash flows. And if we have the cash flows and you want your profit, you need to take out some expenses. Over here, the only expense is depreciation. And so we need to take out since we have added to get the total cash flows for the entire 6 years, then we also need to find the total depreciation for the entire 6 years. How do we get a total depreciation? We are told that the cost of the equipment that is used for the entire project is 240,000. And then we are also told that there is an estimated scrap value of 24,000. We all know that we need to take out the scrap value from the cost to get a total depreciation. That is what it means. To get the annual depreciation, after taking out 24,000 from 240, you divide by 6. But in this case, we need a total depreciation. So there is no need to divide. Okay, so we'll say less depreciation. And that is going to be 240,000 minus 24,000. And that is going to give us 216,000. And so you can do your own calculation. You can decide to find your own annual depreciation and then multiply by 6. You still get 216. So when you take out 216,000 from 324,000, that gives you your profit, your total profit for the 6 years. Total profit. And so your total profit is going to be 108,000. Okay, so now we have the total profit for the entire 6 years to be 108,000. But the formula requires that we use the average profit. So now that we have the total profit to be 108,000, we can find our average profits. And our average profit is going to be 108,000 divided by 6 years. And therefore, our average profit that is to be used to find the accounting rate of return is 18,000 Ghana cedis. 18,000. So this is our average profit. And we are going to use this average profit of 18,000 for both the initial investment approach and the average investment approach. That is how to go by that. Okay. So now that we have our average profit to be 18,000, let's keep that in mind. I'm going to clean it and then we are going to find the accounting rate of return. Using the first, look at the requirement again. We are told to A, calculate the accounting rate of return of the project using the initial cost of the equipment to calculate the capital employed. So that is the first one we are going to do. Okay, so requirement A, accounting rate of return equals to average profits over initial investment. Now, even though we are saying initial investment, we are not using only the initial cost. Remember that the working capital is also an investment. Take note. So the working capital cannot be ignored. Whether you are using the initial investment approach or you are using the average investment approach. If you are using the initial investment approach, you add the working capital to your cost of equipment. If you are using the average investment approach, you add your working capital still to your average investment. So take note that whether you are going by average or initial, the working capital is a must to be added. So it means that your ARR, it will be 18,000 because that is what we had for the average profit. So 18,000 over the initial investment is 240,000. So let's say it should have been that. But I told you to remember to add the working capital as part of the initial investment. Okay, and so 18,000 over 280,000 times 100. So this is our accounting rate of return. And ladies and gentlemen, our accounting rate of return is going to be 6.4%. So this is the accounting rate of return using the initial investment. So it means that when we embark on the project and we are calculating accounting rate of return based on the initial investment approach, we are going to get a return of 6.4% on the investment. Remember that the Part C wants us to evaluate the decision whether to go for the project or reject the project. And we have been given the company's average return on capital employed as 10%. And we know that to make a decision on ARR, if the ARR is more than the company's return on capital employed, the project should be accepted. If it is less, the project should not be accepted. Then looking at this, it's clearly that it's less. But let us get to the Part C and make the evaluation. So we know we cannot embark on this project using the initial investment approach. Now, that is it. So let us also look at the second requirement. We are told to calculate the ARR of the project using the average cost of the equipment to calculate the capital employed. Now, we all know that to get the average cost of the investment, it is the equipment cost at the beginning plus the equipment cost at the end divided by 2. That is the average. And so we remember to add the working capital. Just as even though we know that the 240 was the initial capital which we are requiring, yet we added the working capital. The same way, when we get the average, we need to add the working capital. So let's do workings to find our average, the average investment, which we will use as a denominator for the second one. So average investment. How are you going to get the average investment? I have told you that it is your initial cost of the asset plus the value of the asset at the end of the period. How do we get the value of the asset at the end of the period? That is what we call the scrap value. The scrap value is the value of the equipment at the end of the period. So 240,000 is the initial cost plus the closing cost divided by 2. That is how to get the average investment. So it's going to be 240,000 plus 24,000 divided by 2. So this is how to get the average investment. 240,000 plus 24,000 divided by 2. And remember that I said you still have to add your working capital because it's also an investment. Working capital, we don't find average of it, just as we did here. So after you have gotten your average, we add the working capital and we call all the average investment. Okay, so that is going to give us, this is going to give us 132,000 plus 40,000, which is the working capital. And therefore, we have 172,000 Ghana cedis as our average investment. So now that we have the average investment to be 172,000, we are going to use the same average profit of 18,000 to find another accounting rate of return. Okay. Okay, so now that we have our average investment, let us find the accounting rate of return using the second approach. So accounting rate of return using the average investment approach. The formula is your average profit. Average profit over average investment. And we know that when you get the average investment, you add your working capital, but we've done that already. So average investment, average profit over average investment times 100. Okay, and therefore, accounting rate of return in this case will be 18,000 Ghana cedis, which we have established already, over 172,000, which is the average investment plus the working capital times 100. And that is going to give us a percentage of 10.5%. And so, ladies and gentlemen, we have the accounting rate of return using the average investment approach to be 10.5%. And then we have the accounting rate of return using the initial investment approach to be 6.4. Now, we are told from the question that a company's return on capital employed, ROCE, is 10%. And I told you that to evaluate decisions on accounting rate of return, the benchmark is the return on capital employed of the company or the firm in question. Now, the requirement C, let us read the requirement C again. We are told that suggest whether or not the project should be undertaken on the basis of its expected ARR. Now, look at, we have two different expected ARR. The first one is using the initial investment approach. We had an accounting rate of return of 6.4%. And then using the average investment, we have 10.5%. So if you are using the return on capital employed as a yardstick, then you will say that if you are going by the initial investment approach, then the project should be rejected, not embarked on, because the ARR is lower than the company's return on capital employed. But if you are going by the average investment approach, the project should be undertaken or should be accepted because the ARR is higher than the company's return on capital employed. And that is how to go by the accounting rate of return. I'm sure that this has been very exhaustive and you have really understood the accounting rate of return. So what I'm going to do again in this video is to solve another question on the payback period. And then I'm sure that we can be also enhanced on that as well. Okay. So let us also solve this question on the payback period. A company must choose between two investments, project A and project B. It cannot undertake both investments. The expected cash flows for each project are, so we have project A and B and 4 years, from year 0 to year 4. I've already told you that the initial investment is always represented by year 0. So year 0 is 80,000 for both project A and B. Year 1, the cash inflows, 20,000 and 60,000 positive, respectively, 36 and 24,000, 36 and 2,000. And the year 4, only project A brought in some cash flows. So as you can see, that is the one in brackets, the 80,000 is the cash outflow, and the positive figures are inflows of cash. The company has a policy that the maximum permissible payback period for an investment is 3 years. And if a choice has to be made between the two projects, the project with the earlier payback will be chosen. Required. 1. Calculate the payback period for each project. A. Assuming the cash flows occur at the end of the year. B. Assuming the cash flows after year 0 occur at a constant rate throughout the year. 2. Are the projects acceptable according to the company's payback rule? Which project should be selected? And then 3. Do you agree that this is the most appropriate investment decision? All right, so just as I taught you from the previous video, or in the part 1 of this video, I taught you how to use the cumulative approach to find your payback period. And we know that the payback period has to do with the length of time it takes for the project's initial cost to be recovered, okay, or to be paid back. Okay, so let's try and use a cumulative approach and let's do it together. So we'll say here, then for project A, we are going to look at the cash flows and the cumulative cash flows for project A. So these two will be for project A. And then we'll do the same for project B. We'll have the cash flows and we'll have the cumulative cash flows. Okay, I'm sure you remember this approach from the part 1 of this video, which I taught you. Just that we did for only one project. Now we are doing for 2 projects at a time. And so we are starting from year 0, year 1, year 2, year 3, year 4. Okay, now the cash flows were already given in the question, but we are going to use a cumulative approach to find the payback period. So let us list the cash flows as has been given to us from the question. Now, from the question, for project A, the initial cash flow at year 0 is 80,000 in brackets. The same applies to the project B, 80,000. So both projects will require the same outflow, but the cash inflows are different. Project A, year 1 is 20,000, year 2 is 36,000, year 3 is 36,000, and then year 4 is 17,000. These are the cash flows for the project A. And then for project B, the cash flows are year 1 is 60,000, year 2 is 24,000, and year 3 is 2,000. There is no cash flow for year 4. So these are the cash flows given to us from the question. So let us find the cumulative cash flows for project A and the cumulative cash flows for project B, and then we can determine the payback period. Very simple. So how do we find the cumulative cash flows? Let us look at that. Now, in year 0, we made a cash outflow of 80,000. We are dealing with project A first, and then we can also do for project B. Now, project A, 80,000. So it means that in year 0, the cumulative cash flow was still 80,000 negative because we have not recovered any of them. Now, in year 1, the project paid back 20,000. And if the project is paying back 20,000, it means we have a balance of 60,000 still to recover. That is what it means. You have put out investment of 80,000, you have received 20,000 as a cash inflow in the first year. Cumulatively, you still have 60,000 to recover. Then in year 2, the project paid back 36,000. So if you take out 36,000 from 60,000, you still have 24,000 negative to recover. That is what it means by the cumulative cash flows. And then in year 3, the project is paying back 36,000. Now, if you have 24,000 to recover and the project is giving you 36,000, meaning that you recover it all and still have a positive balance of 12,000. So 12,000 now becomes positive. That is what we mean by the cumulative cash flow. For the year 4, as long as we have entered the positive zone, we don't really care about that, because this is not about the total cash flows or whatever, the NPV, but we are dealing with just the number of time it takes to pay back. But we can equally add that, and then we say we have a cumulative cash flow of 29,000 at year 4. But this is what it means. Now let us look at the cumulative cash flow for project B. For project B, year 0 will still be 80,000 negative. But in year 1, we got a cash inflow of 60,000. And that is going to give us a cumulative cash flow of negative 20,000. That is what it means. And in year 2, we got a cash inflow of 24,000. So that can pay off all this 20,000 and still have a positive balance of 4,000. And then in year 3, when we add that, we have 6,000. So this is all about the payback period. Now, so you see, in order to make a decision on the payback period, you always need to go by this approach. Get your cash flows, get your cumulative cash flows. Now you can make a decision, and the decision will not be difficult for you. Now let us go back and look at the requirements of the question again. The first one says, I calculate the payback for each project. A, assuming the cash flow occur at the end of the year. And B, assuming the cash flow after year 0 occur at a constant rate throughout the year. So these are two different scenarios. So the first one says we should assume the cash flow only occurs at the end of the year. So if the cash flows occur only at the end of the year, then the payback period for for first project A, will be 3 years. Because at the end of the second year, we got 36,000, couldn't pay off the whole project. And if we are assuming that this whole 36,000, they all came at the end of the year, then it's at the end of the year that we're able to recover this 24,000 and have a balance of 12,000. So if we are going by the first assumption, then the payback period for project A will be 3 years. That is by the first assumption. Then we're looking at the second assumption, which says that, okay, so let's look at the first assumption also for project B. Now, for the project B, if we are assuming the cash flows only occur at the end of the year, then it means that this project was recovered at the end of the second year, because at the end of the second year, we were able to pay it off all. So it means that project B's payback period is 2 years. And if you want to make a decision based on these two projects, because project B is paying back in a shorter period than the project A, then based on the first assumption, project B should be accepted and embarked upon. Now, we know that the question told us that the company cannot accept a project that has a payback period for more than 3 years. Even though both projects satisfy the requirements and they are all 3 years or less, we also know that for payback period, the shorter, the better. And therefore, 2 years is shorter than 3 years. So if you are going by the first assumption that the project's cash flows only occur at the end of the year, then we must accept the project with a shorter payback period. And that is project B. Now, make no mistake about that. You can see that even at the end, everything shows that project A will eventually bring us more cash, positive cash flows at the end than project B. However, our decision is not based on the cash flow total or the present value or the total net present value or whatever. But we are only basing our decision on the number of years it takes to recoup the initial investment. And that is why we are accepting project project B as the project to embark upon. Now, let us also look at the second assumption, which says that assuming the cash flows after year 0 occur at a constant rate throughout the year. Now, if the cash flow occur at a constant rate, what it means is that we do not wait till the end of the year before all the cash flows come into our account or to our account. It means that to occur at a constant rate means to occur evenly. So it means that in January there will be a cash flow, in March there will be a cash flow, in February. So every month or every day, in that order, there is a constant rate. Therefore, we don't wait till the end of the year before all. So it means that if you take this 36,000, for example, it's accrued evenly over the year. And that means that we did not wait till the end of the year before we paid off the entire project, or the project paid off. Okay? So it means that this is where we have to find the fractions. Because if we are saying that it occurred at a constant rate, then it means that after year 1, we still had 36,000. After year 2, we paid and we still had 24,000 to pay back. But at year 3, this 36,000 occurred evenly. So it means that it took 2 years and some months. It didn't take the entire 3 years to pay back, because at the end of the 3 years, we even had a positive value. So how many months more did it take after the 2 years to pay back? So it means that the payback for project A is going to be the 2 years plus some months in the 3rd year. It didn't take the entire 3rd year to pay back. It took some months. So it's going to be 2 years plus, okay? It was left with 24,000 to pay, and then we got 36,000. So it's going to be 24,000 over 36,000 times 12 months, just as I taught you in the part 1 of this video. And that is going to give us 2 years and 8 months. So what it means is that it took us 2 years, 8 months for the project to be paid back. So the payback period, assuming that the cash flows occur at a constant rate, is 2 years, 8 months, not 3 years. Now, using the second assumption for project B. Now, project B, at the end of year 1, we had 20,000 more to recover. But at the end of year 2, we were having positive. So it means that it didn't take 2 years exactly. It took us 1 year and some months. So how do we find the months? So we had 20,000 to recover. We got 24,000 as a payback. So the project B's payback period will be 1 year plus how much you have to recover over how much you actually had within the year times 12 in brackets. This is how we go by that. So the payback period for project B is 1 year, 10 months. Okay. Now, the second requirement, we are already answering that the B, which says which project should be undertaken. We have said that under the first assumption, this project B should be undertaken because it gives us a shorter payback period. Under the second assumption, yes, we still have the payback period. Project A's payback period is 2 years and 8 months. Project B's payback period is 1 year and 10 months. And therefore, Project B should still be undertaken because it gives us a shorter payback period. And that is the meaning of what we are trying to explain. Okay, I'm sure this is very understandable. Now let us look at the final requirement, requirement C. The B has already been answered. So look at requirement C or requirement 3. Do you agree that this is the most appropriate investment decision? So this is like a critique on the payback period. This is not the most appropriate investment decision because it ignores two most important things. One is the total cash flows. Now, even though you see that we are all saying that we should select the project B to embark upon because it gives us a shorter payback period. However, we can see that project A gives us a total cash flow of 29,000 positive, whereas project B gives us only 6,000. So it is not appropriate. It ignores the value of the cash flows. It just considers the total payback period, and that is all. So that is a disadvantage of the payback period. Another reason why this is not the most appropriate investment decision to use is because it ignores the time value of money, which we are going to deal with as part of our investment appraiser in the next video of this investment appraiser. We are going to look at the net present value, the discounted payback period, and the internal rate of return. So that is where we are going to apply the time value of money to investment appraiser decision making. Okay, so that is how to go by this question. I'm sure that this has been helpful and your understanding of these two methods has been really enhanced. Remember to subscribe to this channel if it is your first time. Share this video and let others also have a benefit. And until we meet again for the part 4 of this lesson, it's bye for now.